Okay, so you want to own a car dealership, lease a nice lot, fill it with shiny inventory, hire some smiling salespeople, and let the deals roll in. Here's the first number that should freeze you in your tracks before you sign anything. The average franchise new car dealership in America runs on a pre-tax net profit of somewhere around 2% of total sales. 2%. That means a store moving $100 million in cars and service across the year keeps roughly $2 million after everything's paid, and in a soft year, far less. That gap between the enormous money flowing through the doors and the sliver that actually stays behind is the whole story of this business. Understand that gap and you understand dealerships. Miss it and you'll go broke owning the busiest, glossiest, most envied storefront on the boulevard. Let's start with why anyone opens one of these in the first place. Auto retail is one of the largest consumer spending categories on earth. In the United States alone, dealerships move well over $1 trillion in vehicles and services every year. Even a paper-thin cut of a number that big can make someone genuinely rich. But here's what stuns almost everyone walking in for the first time. Selling cars is not a fat margin business. It's a razor-margin, high-volume business wearing an expensive suit. The gross profit on the front end of a new car, the difference between what the dealer paid and what you paid, averages only a few percent. On a $30,000 car, the front-end gross might be barely $1,000. Sometimes less, sometimes nothing at all. So if the cars barely make money, how does anyone survive? That's the first thing you have to unlearn. Because a dealership isn't really one business. It's 4 businesses stacked on top of each other, and only some of them actually pay the bills. Business 1 is new cars, the flashy part everyone pictures. And it's often the weakest. In plenty of stores, the new car department barely breaks even on its own. Business 2 is used cars, where a good operator can pull 10 to 12% gross because there's no factory setting the price for them. Business 3 is finance and insurance, the F&I office. That little room they walk you into after you've already fallen in love with the car. Extended warranties, gap coverage, financing markup. Around $2,000 of gross profit per vehicle on average. At margins the sales floor can only dream about. And business 4, the quiet giant, is service and parts. The repair bays. Margins back there run 45 to 55%, and here's the part nobody outside the industry understands. The department with the cars in the window isn't the one keeping the lights on. The greasy shop in the back usually is. There's even a name for it, the absorption rate. It measures how much of the entire dealership's fixed overhead the service and parts departments can cover all by themselves. A well-run store aims to absorb most, sometimes all of its overhead through the shop alone. Hit that number and every single car you sell out front is nearly pure upside. Miss it and you're praying the sales floor covers rent every month. The best dealers stopped thinking of themselves as car sellers a long time ago. They think of themselves as service centers that happen to have a showroom attached. Now for the number everyone gets wrong before they ever unlock the door. People imagine you can start with a small lot and a dozen cars. You can, if you want to run a tiny independent used car operation. That might cost you $50,000 to a couple $100,000 to set up. But a real franchise store with a manufacturer's name on the sign? You're looking at anywhere from several $100,000 to well over $1 million before you've sold a single car. And for a large metro franchise, a great deal more than that. Here's where the money actually goes, and this is the part nobody warns you about. First, the manufacturer has to award you the franchise. You don't just buy in. Then there's the facility. Manufacturers run what they call image programs, and they can require you to build or renovate your showroom to their exact brand standard. A bill that routinely climbs into the millions. Then the lot, the signage, the software, the technicians, the tools in the bays, and then the single biggest number of all, the one that makes new owners feel the ground tilt beneath them, the inventory itself. Because you don't buy your cars with cash. Almost nobody does. You buy them with something called a floor plan. A floor plan is a revolving line of credit, backed by the vehicles themselves, that a lender extends so you can stock your lot. Think of it like a giant credit card, where every car is a charge. And here's the trap hiding inside it. You pay interest on every vehicle, every single day it sits unsold. When rates are low, that's a nuisance. When rates climb, it becomes a slow bleed you can feel in your bones. Holding costs, floor plan interest, insurance, depreciation, the opportunity cost of the cash can run $30 to $40 per car, per day. A single unsold vehicle sitting 90 days can quietly eat over $3,000 before anyone buys it. And it gets worse. Because floor plan lenders make you pay down principal on aging cars whether they've sold or not. It's called curtailment. The car's been on the lot too long, so now you owe a chunk of its cost back to the lender out of your own pocket, for a vehicle still sitting there losing value by the week. In this business, there's a saying, time kills gross. Every day a car ages, it's worth less, it costs more to hold, and it inches you closer to selling it at a loss just to stop the bleeding. So let's say you've survived the setup. Now you need to actually move metal. And this is where the real education begins, because a dealership is a machine measured in days. The single most important number on the whole lot is days supply. How many days of selling it would take to clear your current inventory at your current pace? Too low and you've got empty spaces and nothing to sell. Too high and your floor plan is hemorrhaging interest on cars nobody wants. The best operators turn their inventory 12 to 16 times a year, meaning the average car sells in about 30 days. Let that number creep to 60, 90, 120, and you're no longer running a dealership. You're running a very expensive parking lot with a loan attached. Here's the trap almost every new owner falls into. They fall in love with volume. They chase the manufacturer's monthly sales targets, because hitting those unlocks factory bonuses and rebates, and they stuff the lot with cars they'll have to discount to move. They sell more units than the store down the street and still lose money on every one, because the front-end gross evaporated the moment they started slashing prices to make the number. In the industry, that's the whole grim comedy of it. You can win the sales race and lose the business at the exact same time. Now let's talk about the costs that never show up in the fantasy version, because these are the ones that actually sink stores. Reconditioning is a quiet killer. Every used car you take in trade needs work before it's sellable, and that cost gets buried in the daily grind until someone finally adds it up. Then there are chargebacks. Remember all that F&I profit, the warranties and the gap insurance? If the customer pays off early or cancels, the dealer has to give a big slice of it back. Book the profit today, lose it 3 months from now. And then there's the manufacturer itself, the partner who can turn into a landlord, a boss, and an auditor all at once, setting your standards, auditing your warranty claims, clawing back incentives if your paperwork's a hair out of line, and holding the power to make your franchise more valuable or nearly worthless, depending on how the brand is doing that year. Now, here's a real company, a real name, and a real collapse. Because nothing teaches this lesson like watching it happen to people who looked untouchable. Meet Tricolor, a used car retailer and lender operating across the southern United States, built around selling vehicles and financing to customers most banks wouldn't touch. On paper, it was a machine, dealerships, a lending arm, billions in loans bundled up and sold to Wall Street. For years, it looked like a company that had cracked a market everyone else ignored. Then, in September of 2025, it filed for Chapter 7 bankruptcy, not a restructuring, a straight-to-liquidation collapse, listing liabilities that ran into the billions. Major banks disclosed they were staring at losses. One flagged a potential $200 million hit tied to what it called fraudulent activity. Federal prosecutors moved in, and the alleged mechanism at the center of it was chillingly simple. The same loan portfolios pledged as collateral to multiple lenders at once, each bank believing it alone held the claim. One note for accuracy, the fraud allegations against Tricolor's executives were still moving through the courts as of my knowledge cutoff and had not been resolved. Treat the specifics as alleged. So how does an operation that large, run by people who supposedly understood the market cold, vanish that fast? The answer isn't just fraud, it's structural. The whole model rested on borrowed money financing depreciating cars sold to buyers on thin credit, with cash flow stretched tight across the entire chain. When the pressure came, there was no cushion, because there almost never is in auto retail. The margins were thin, the leverage was heavy, and the appearance of health was propped up by financing that was quietly straining the entire time. Keep that in mind the next time the deal in front of you looks a little too clean. Once a store survives all of that and starts to thrive, growth stops looking like selling cars and starts looking like corporate finance. You buy a second store, then a third, and now you're not managing a lot. You're managing a portfolio. And the thing that ultimately decides what any of it is worth has a name that sounds almost poetic. Blue sky. Blue sky is the goodwill value of a dealership. The intangible premium a buyer pays on top of the physical assets, calculated as a multiple of the store's earnings. A strong domestic or import franchise in a good market might sell for several times its annual profit in blue sky alone. A struggling brand in a weak location, the multiple shrinks toward nothing, and sometimes below it. which means your dealership's real worth isn't the cars or the building. It's the trust the brand carries, the profit you can prove, and the confidence a buyer has that the machine will keep running after you hand over the keys. So who actually gets paid at the end of all this? And how much? A dealer principal's income comes from two places: a management salary treated as overhead, and a share of whatever profits left at year-end. A small independent operator might clear anywhere from double digits into the low hundreds of thousands, riding hard on the swings of the used market. The owner of a well-run franchise store, one that's mastered its absorption rate, its inventory turn, and its F&I office, can take home several $100,000 to well over $1 million a year. Same brand, same cars, same customers walking through the same door. The difference was never who sold harder. It was who understood the numbers underneath the sale. So how does anyone actually make money once you strip away the disasters? It comes down to the mix. Lean too hard on new car volume and you'll grind out sales for almost nothing. Build up your used operation and your margins breathe. Run a disciplined, honest F&I office and you capture the profit the sales floor gave away. But above all, feed the shop. Because the mechanism that quietly rescues nearly every profitable dealer's year isn't a hot new model on the lot. It's the service drive humming full every single morning, absorbing the overhead, so the whole rest of the store gets to keep what it earns. Now let's do the math the way any serious dealer would, because two scenarios on identical revenue is the only honest way to close this. The optimistic year. You're a franchise store doing $100 million in total sales, running around a healthy 2% net. That's roughly $2 million in profit. Your inventory turned fast, so floor plan interest stayed low. Your service bays ran full and absorbed most of your overhead. Your F&I office held its gross with minimal chargebacks. Life is good. You're the dealer the other dealers resent. Now the realistic year. Interest rates climb, and your floor plan cost per car quietly doubles. A batch of cars ages past 90 days and hits curtailment, so you're paying down loans on vehicles you'll ultimately dump at a loss. The manufacturer mandates a facility upgrade you have to fund, whether you like it or not. Chargebacks eat into last quarter's F&I wins, and your service department, the one thing holding the whole model up, slips just enough that it stops covering overhead. Run that same $100 million through that reality, and a 2% margin doesn't just shrink, it flips into a loss. You didn't sell worse cars in the bad year. You sold the exact same cars, from the exact same lot, to the exact same town. The only thing that changed was which side of a handful of numbers you happened to land on. The interest rate, the inventory turn, the absorption rate. That's not bad luck. That's the actual architecture of this business. So, is owning a dealership worth it? It hands you one of the largest revenue engines any local entrepreneur can ever hold, a brand people recognize, and a place in the fabric of your community. But it demands an owner who treats the business less like a car salesman and more like a bank that happens to keep vehicles out front. Someone who reads floor plan curtailment schedules and absorption rates as fluently as they read a customer's face. Every number in this script, the 2% margin, the daily holding cost, the curtailment trap, the chargeback that undoes last quarter's win, the fine print in a franchise agreement, exists for one reason. It filters out the people who wanted to sell cars from the people who actually understand what they're running. The lot, the inventory, the salespeople, that's the easy part. Anyone with enough capital can assemble those in a matter of weeks. What separates the dealer still standing in year 10 from the one who quietly disappears in year 2 was never who moved more metal. It was whether they respected the machine behind the showroom, the cash flowing through the floor plan, the overhead soaked up by the shop, the profit slipping quietly out the back through chargebacks and aging inventory. The people who thrive here were rarely the smoothest talkers on the floor. They were the ones who understood, long before they ever unlocked the doors, that the real business of a dealership isn't selling cars. It's surviving the gap between what rolls in and what actually stays.